major trend is still down, and so we're going to have to embrace the suck for a while.
This is Matthew Kruse at Comstock Investments. I have with me the founder of Comstock, David Kruse. Let's maybe start out and talk about the news for today is the trade deal with Japan. I see the stock market is up for the moment. They seem to like that news. What do you think that really means for agriculture and the economy?
Well, there's several features in the deal that do impact agriculture. Japan imports about 770,000 metric tons of rice, and up to this point, we've been providing about half of it. The deal supposedly says that we get to increase our exports to them by 75% on rice. So that means that we would be meeting most of their import needs relative to rice if that happens. As far as I did look and see what the reaction was in the rough rice market, and it's up like 10 to 15 cents. No huge thrill there as far as that goes. The deal, I think Japan did $148 billion worth of trade with us. We'd get about $22 billion in revenue from that as far as the country goes, and that's basically charging them $22 billion as a cover charge to get to do business with the United States of America. I guess the entity that is most displeased here in the United States this morning would be the auto industry. Japan gets a 15% tariff rate. Japanese vehicles are virtually all Japanese parts made, and no other contributions. Well, here on this continent, we've got Canada and Mexico, where those automobiles contain a lot of U.S. parts, and they're at 25%. And so they're looking at this as really a bad deal this morning, that Japan gets a 15% tariff with no U.S. parts in their autos. In Mexico and in Canada get 25%, and there's a high level of U.S. parts in all of those autos. And so I guess that's probably the biggest criticism that I've come across.
I read some contradicting news that, the Japan's prime minister said that he didn't actually agree to spending a fixed amount on ag products, which is a little bit different than what we're hearing from Trump. And that's the problem here, is we always get this contradicting information, so you don't really know what to believe and what's serious. And Japan is our number 2 largest corn buyer behind Mexico, and got this big news, and yet we're down a penny. So it really kind of shrugged the news off.
Great shake there. Yeah.
We're supposed to be getting $500 billion, $500 billion of investment that Trump makes it sound like we can do with as we please. Assuming that's true, how would you spend that? If we got $500 billion, what would you spend it on?
Well, what he wants them to spend it on, I think, is liquefied natural gas terminal, whatever, in Alaska. He wants them to be part of that. But the Japanese have been aggressive investors in the United States the way it is. They're probably more than any other country. They've invested hundreds and hundreds of billions of dollars into the United States. They make a lot of their products here and that are U.S. content. And then besides that, they finance our treasury by $1.1 trillion. So they're buying all of our treasury bonds besides. They've been a wonderful trade partner for us. I think they were relieved, is the impression that you got from this morning from what their side of it was, from the results of the trade pact. I think their prime minister, his comments was mission accomplished. They were evidently happy with what they got.
I've been reading how, based off of some of our recent trade deals, and there's only been like 4, like the 10 or 15% tariffs are the new 0%. And so it's pretty hard, based off what we're seeing so far, that anybody's going to go back to 0. Like, everybody's going to get something. They're going to stay at 10 or 15%. And so it's just how much higher above that are you going to go? But, it doesn't seem like so far he's willing to, allow everyone to go to 0.
Well, the interesting one will be the European Union. They have one of the larger trade deficits with us, which is the thing that's supposed to rally them up the most. They were initially shocked and appalled, I guess, by this 10 to 15%, that no way in the world should they be charged 10 to 15%. Well, I think it'll be more like 20 or 25 if you base what you would think that they would get on what we've seen here in these recent deals. It would be even higher still. It'll be interesting, whether they're willing to choke that down or whether they'll come with the retaliation. I guess my bet today was they will not be as agreeable as Japan and some of the other ones. And right now it's not really a trade war. It's just we're just telling everybody else what to do, and nobody too much is fighting back except for China. That might not be the case with the European Union. We'll see.
It seems hard to believe that everybody's going to get on board with this, but people get excited. He's got a few deals done, but there's 4 down and 150 to go. So
low-hanging fruit at this point.
Yeah, low-hanging fruit. That's a good way to put it.
Yeah.
Well, what do you have for us today?
The title is Embrace the Suck. I think we all know that we're in some tough times economically here, and the agriculture, our net farm income is down, and we've got a lot of barriers that we're faced with right now as far as the trade war goes, and so we're going to have to learn how to deal with that. I came across this comment here. In the military, when they're faced with these kind of challenges, they say embrace the suck. And so we were kind of coming up with a program that's similar to that. I think that farmers can look at, we're going to have to get tough when times are tough. And so that's how we go forward here. The one thing that we do have going for us this year is it looks like we're going to have some phenomenal production unless something changes dramatically. And it's getting already far enough into the season, and our conditions are set now for further into the season that it would seem like we're going to be looking at some very high yields, and that will help us. Ultimately, when that's confirmed to the market may not help us. But it is amazing. I mean, I've farmed for 51 years, and you've taken over the operation now this year. You walk outside here and you look at the grass, you look at the trees, you look at crops. And the green is so green. It actually almost hurts your eyes. It's crazy. We've had this wonderful moisture and situation along with a lot of heat units. And it's pretty remarkable. That's what I just described, I guess, is how it looks like from the ground. When you get up to a satellite, it must look similarly. These are the NDVI indexes for, I think the top one, if I remember correctly, is for Iowa and Nebraska. You can see it's poking out the top of the channel. The satellite's never seen anything so good either. That's also the case in China, which is the bottom one here. China, and then their corn and soybean growing area, is seeing some very excellent weather too. That might mitigate some of their need or whatever for some imports here going ahead. We all realize that this is not the drought of 2025. It's almost in some places closer to the flood of 2025. I just thought this was some interesting history. This is taken from the drought monitor. There's drought and then there's drought. And the severe drought is really what kills crops. If you look at the bottom line there, 1% right now is of the U.S. actually corn and soybeans is all that's in severe drought in the United States. And you can see that even though the modest drought is down significantly. And so we're not going to see a lot of impact from that. In many cases, we'll lose more crop maybe to too much water in the Mid-South and things from this year. Drought is not an issue.
Yeah, it's changed a lot in the last year, basically, yeah. And, I mean, you can find a lot of people complaining last year. And the thing is, we still got 179.3 on the corn yield last year based off that. And so it's hard for the market to take any complaints seriously, when you go from 81% to 9% from one year to the next. So it's just a dramatic change.
Been adopting for a strategy is, first of all, we used using our 230 bushel APH, and we've now moved up to 50% hedged actually in both our corn and soybeans. Looks to me like we're increasing our yield prospects here. I went from 250 to 275 actually for my prediction would be for our primary farms or whatever as things progress. This green is amazing. And so we probably need to advance a little more quantity to even be 50% hedged. Typically, that's about as far as we ever get on new crop. There is this, we don't know what we're going to raise. And so we're comfortable with that, but that's about as far as we generally get. I've included a couple of charts. When I started out the planning for this year, okay, what's the trend? Is the major trend up or is the major trend down? Dave Toth, he's the technical analyst for our clearing firm, RGO. I think awful highly of his work. Been doing this for 50 years. And I think he is probably the best technical analyst that I've ever been associated with. And the main thing is that, well, in the short term, the markets, they move. They're up, down, volatile, whatever. But what is that major trend? And looking at the technical analysis in both corn and soybeans, it still looks like it's lower. That means that maybe that's going to happen because of phenomenal yields. Maybe it's going to happen yet because there's going to be some disappointment in trade deals and with China, whatever. But as we look ahead in this next year, I still think there's a strong chance of new lows. And by new lows, I'm really targeting the August 2024 lows. I think that was about 385 in corn. And for this overall multi-year bear market to be done, I think that we need to take out that low to finish it. And so that's where we're at, and then what we're kind of planning where our revenue is going to be based upon around that idea.
So you think we can move even below that 385 level?
I think we have to wash this thing out. You say you get, I don't know what the yield's going to be, but that's not hardly inconceivable at all. If you get 185, 6, average corn yield, and you don't get any help from trade deals. If we do get into a war with Europe, they have on their retaliation retaliation list, soybeans. Well, the first time around, in the first term with Trump, when we had our blow up with China, what we did basically is rearrange the sourcing around the world for soybeans. China didn't buy ours, so they started buying more from Brazil, but then Europe, which had been buying them from Brazil, bought them from us. And so we basically just had a merry-go-round there of different changes in those sources. Well, right now, China's not buying from us. I really kind of doubt that they will. And if we get into a real tiff with Europe and they put tariffs and such on our soybeans, where's this going to come from? Where's the replacement? They're going to go to Brazil or Argentina too. We're going to have a problem along those lines. And so we'll see. Yeah. We need to be doing a lot more for our own domestic demand than we're doing in the terms of biofuels. And I don't see that happening like it should be.
I think what has saved us, obviously, until this point has been our strong export market. And as I think people are pointing out, that China, who's historically been our biggest customer, has been completely absent the market. And now in the case of corn, I think we've learned that we can kind of replace them with other buyers. Mexico has been buying a lot more to Japan, but it doesn't seem like we can do that with soybeans. That we can't replace China with, even if we add all the next 10 buyers together, they still don't amount to what China has historically bought from us. And they historically already bought quite a bit at this point in the year, and they're not doing it. And so that's a huge, I guess, point of concern or red flag, going forward.
I don't think the focus right now is even on ag with China. The focus is on rare earths and these
computer chips and all that.
Yeah, and all that. That's really what they're arguing about. And one of these days they might get around to figuring out ag again, but they seem to be taking their time. Trump seems to be perfectly happy with taking time, as long as what he's essentially doing is saying, here's your tariff, this is what you're going to be paying until we make a deal. And that just keeps the picture on them.
I look at this chart, and one thing that kind of sticks out to me is this August 2024 low.
Right.
It almost it lines up well with this 2014 low. Early season 2014 low. We rallied back, similar to how we rallied back here, but then we started another whole leg lower here as we moved into the second half of 2014, and that's our concern. Is we're so far we're heading in that same direction, and we're kind of sitting right here. We're about in this area right here, and so what's different this time? What is gonna make this from moving 80 cents lower? A lot of people have said, we've created a whole new threshold higher where, it used to be $4 was the high end of the range, and now that's the low end of the range. We'd like to believe that makes sense. Things are lining up where, as we just pointed out, they're so perfect. Tariff wars are going along. We're eroding our export market. Is global demand or is domestic consumption gonna increase enough to offset that and pull us out of this hole that we appeared to be digging ourselves in? And that's the point of concern, I guess.
Well, we've talked about, the exports actually being good this year. In my opinion, some of that is front loading.
Yeah.
There are countries out here, when we entered this trade war, got concerned. And I believe it's a natural response to build some protective stocks around them. And so they didn't want to go too far into this trade war with empty bins. And so I think that has been responsible for some of the improvement in the exports. But as things get settled, one way or the other, that is not going to be long lasting. Yeah. And so some of that demand might not be as real or as long term as what we would expect there. But if we get up there in the 180s for a yield, our carryover is likely to project up closer to 2 billion bushel. And that means that what do we do next year? We've got to cut back on acres then. We're going to have a problem. You pointed out, how it quickly went to new lows last time. It doesn't have to. We can mess around here for even a couple of years in this range before we would go to a new low. But what I'm suggesting here is that this major bear market is not over. It needs one more new low to really get to completion. And I'm not in a hurry, but you can easily see in today's fundamentals how it could consummate.
If I were to say, where are we right now? You look about July 2014. And what happened? It couldn't sustain the support levels, collapsed, another leg lower. And so we're sitting right at that same spot. And the market is looking at the weather right now and looking at the heat levels, and it's trying to determine, okay, is there any reason why we can hold here and move higher, or at least trade sideways. And so you look at the weather outlook, and it still looks pretty darn good. And so, for the August report, why would, at a minimum, they not increase the yields higher? Why would we not go to at least 183? We did last year, and conditions are arguably much better. And so why would we not go to 183? A lot of people are arguing for 185 or higher.
That'll be the argument for the other side. They're overestimating it, or at this point, the market's got too high of a yield in there. Well, I guess we'll see, but I'd rather be conservative on this side of it. It's the same situation on soybeans. We've had this consolidation. I don't know that anybody breaks even around $10 soybeans. Well, we sure don't when we get closer to 8. And you can see where that long-term support has been. And as you suggested, our export situation on beans is probably even more in question than it is in corn. That's just the similarity of the chart there.
I think we're heading in that direction. Here's kind of that 2014 path where we found a low at that $9, $9.05.
Yeah.
And we're kind of heading that same direction. But yeah, $10 really doesn't work. You need kind of a minimum of $11 in futures. $11 in cash would be even better, but I don't know if that's in the cards right now. But if corn is at negative, I don't know that beans are going to prop it up. But they have a little bit better outlook, I think, than the corn does, just because we plant a lot more corn. The yield is probably going to shift higher, but the yields for beans are made in August, so there's a little bit more time for things to get messed up there.
Probably the earliest planted soybean crop we've ever had, though, for most of the country. That pushes that forward just a little bit, and right now we're sitting here on the 23rd of July with essentially full profile of subsoil moisture. So where we live, I guess that's about 11 inches of water that can be in the ground, and we've canopied at this point, and we've got nice heat units. It doesn't look very dire for the soybean crop either. So a number of the things that we did here to protect ourselves, which I considered that to be bracing the suck, I guess, is we did elect to take about our maximum potential coverage from crop insurance. We did the 85% revenue insurance plus the ECL, which picks us up to about 95% of APH on corn. On soybeans, with the 85% plus the SCL gets you to 86%. So if we take our corn and we used our APH of our farm, which was 230, that comes up at $974 an acre. Well, our break even, I think you calculated, is pretty close to $1,000 an acre. That gets us close at APH. Now, if we do get up to 275, I think, and depending on where the price is, we do have half of it hedged at our price side. We could start to move into positive territory as far as revenue goes. Our step 2 was that we did enroll in the ARC and the PLC on those programs. They did improve those reference prices in the Farm Bill. I think that I've seen just some people that are into this and they calculate these things. We just used an estimate, probably we could get up with a $30 an acre average payment from that. So our intention then is, okay, we've hedged this crop. We haven't actually sold the cash in those cases. We've just got the price side hedged. And so we're going to end up, if this is a big crop and it is depressed at harvest time, we're going to want to store it. In our region, we've had short crops in the past years. This will be the biggest crop that we've raised here in several years. That's going to change the basis here too, where we live, where we've had some very favorable basis, and that's going to change. Right now, they're bidding 10 under for new crop, and I think that could be good when we get there, if this crop consummates as it appears that it might. So anyway, we think, though, that there'll be, usually in a bear market situation like that, there ends up to be a carry. In other words, they'll end up paying you to store the crop. So with basis improvement, end up getting paid to store the crop from the carry. We just took an estimate of maybe $93 an acre. There's potential in that improvement from what the harvest low would be before we would actually make our cash sales.
So just to be clear, this isn't a trade recommendation, but these are some of the things that we've incorporated on our farm.
This is our marketing plan and how we're trying to put together enough money so that we're actually profitable this year.
Last I heard, he had well over $100 billion in tariff revenue. Whether you agree with the trade wars or not, that's money sitting there that needs to be spent. What should he spend it on?
Well, he loves farmers, and I do believe that. He expects their vote, and he has promised that there would be some reimbursement for the trade war, and I believe he'll come through with that promise. We're just taking, a rough estimate and saying there's potential there for maybe $60 an acre. acre as far as an ACH from the president for the trade war. I think that can happen. Step 5, again, I guess I'm going back to my local basis and talking about that. For this post-harvest basis improvement, I guess I'm at $69 an acre where I was on that. So we take all this together and you add it together, you get $974 and $30 and $93 and $60 and $69. I come up with $1,226 an acre. And so with a $1,000 break even, I guess the way I put it, by embracing the suck, there's a potential profit there. Again, we realize, this is our marketing plan. At least we've got one. These numbers are not locked down. They're going to change a lot from where it is. They're going to be what they are. What I essentially was doing was searching for strategies and ways to piece together enough revenue so that we could be profitable during these times. And I believe that potential's there. And so we're trying to follow this plan as carefully as we can. And I guess I'm still optimistic that we can come through it for 2025. Next year, it's much more in doubt. If we do go to those new lows as in the marketplace, that's not going to set us up very well. Where we're at right now, it'll be interesting to see what kind of a harvest weather conditions we get, how much subsoil moisture and stuff we're there looking into next year, and then where we're at in the stages of the trade war. But, next February, again, is where it all starts. It's when those crop insurance guarantee prices are set. And until we get to that point and kind of figure out where that revenue guarantee can be set, we're still in doubt. There is some improvement, though. Essentially, the Republicans put a farm bill in the big, beautiful bill. And there's some benefits there. They improve the reference prices for the next year. They improve some things on crop insurance, letting more people take advantage of that SEO and ECO and things. And they also increase the base acres that are covered under their program. And so there was a lot of some significant improvements on the commodity title revenue side that they put in there that will improve the safety net as we go forward into next year. We'll have to, again, the major trend is still down, and so we're going to have to embrace the suck for a while. It'll be more fun, I guess, when things turn around and prospects change. But our idea is to get from here to there. And so this was our marketing plan relative to accomplishing that.
Well, we'll follow up later in the year, early next year, and see if this comes true or not. A lot of it, seems like pie in the sky at this point. There's a lot of moving parts, but it could still happen. There's a possibility. Appreciate everyone watching. And as always, if you want more trade information, specific marketing ideas, you can subscribe to our Comstock Report. There's a free trial link here. Thank you, and everyone have a good day.
Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.